Okay, with that, let's move on to our next management call. Equitas Small Finance Bank is on our radar. The business momentum for the first quarter has been strong, with profit coming above estimates. However, slippages have seen a slight increase. The margin has also dipped a bit. Mr. P. N. Vasudevan, MD and CEO of Equitas Small Finance Bank, is with us. Mr. Vasudevan, thanks for joining in. First, to the positives. I mean, if I talk about the business momentum, your AUM has actually grown 6.25% quarter on quarter. So that's very good sequential growth. There's good deposit momentum as well. Do you think this can continue into the rest of the year? What's the sense you're getting in terms of business momentum?
Good morning. See, Equitas, as we have been saying in the past also, we are lending into segments which are, kind of from the informal economy borrower segments, which typically do have a large level of unmet or underserved, demand from the banks. So that way, there is generally not much of an issue from the demand side. It's largely from our ability to service it in an efficient manner. That really determines our ability to grow. And so we have been guiding for a 25 plus kind of a percent growth rate in the past. And I think that's something that we should continue to be able to look at. First quarter was a little stronger than normal, largely because the last year first quarter was not very strong. So on that lower basis, the growth is appearing to be 36% year on year. But we expect that this year our overall growth rate should be in the range of 25 to 30%.
Okay, 25 to 30% growth rate is what you're looking at. I do want to also talk a little bit about the slippages because they remain elevated in Q1. Can you give us some guidance on that? I think there was a 12% rise that you saw in your slippages this time. From an average of around 200 crores plus, what do you think the slippages could be in the subsequent quarters? And any relief on asset quality that one can expect?
See, our slippages are actually quite under control. I would say it's around that 3% level. Last year, if you remember, it was in the range of around 4.5 to 5% level. It's actually come down in the fourth quarter. Fourth quarter was the best. And first quarter, we all know seasonally is supposed to be the weakest quarter in terms of collections. But actually, our first quarter collection was much more robust than the typical first quarter that normally that we have seen in the past. So our first quarter collection was good, and our annual slippage at just under the 3% level is actually quite comfortable, I would say. And also, the way we calculate slippage is like on a daily basis. So if somebody slips into an NPA today and pays it off and squares it up tomorrow, we still show it as a slippage and a recovery. So I don't know whether that could be an impact, but even otherwise, at 3%, I think we are very comfortable with that. And from a portfolio quality that you mentioned, our GNPA has kind of remained flat at 2.6% quarter on quarter. And again, I think that's a good good show by the team because normally we have seen the first quarter that the GNPA does tend to rise up a bit and then come back in the subsequent quarters. But this time around, everything has been good. The market has been good. The economy is actually doing well. So we have also seen that impact from the customer side. The earnings has remained robust, and actually our GNPA has remained flat, which I think is probably the first time that we have seen in a long time.
So, Mr. Vasudevan, what's the outlook? I mean, are you saying that even if slippages rise, the max it will be is 3%? And can you give us some guidance on the GNPA levels as well?
Yeah, I guess the slippage should be in the same range. I don't expect it to go much beyond this, give or take maybe 10 basis points this way, that way. And from a GNPA perspective, pre-COVID, our GNPA used to be 2.5% level. We are now practically close to that at 2.6. And going forward, I think for the rest of the year, given the kind of macroeconomic factors that we have seen playing in the market, I think our GNPA should be in the range of 2.5% for the rest of the year.
Okay, 2.5% range for the gross NPA, so lower than what you've seen in Q1 and lower than what you've seen last year. That's always great to hear. Now, if you look at the book, right, the microfinance book has seen a very strong growth. It's a 40% growth that you've seen. Of course, the base is also lower, but is this something that you can sustain in the quarters to come?
See, microfinance, there was a change from RBI about a year back in terms of regulatory framework for microfinance. There is always a large concern amongst all of us in terms of overborrowing or over leveraging by the borrowers. because the RBI guideline was addressing the NBFC MFIs, but it was not addressing the banks. So customers could potentially borrow from NBFC MFIs up to the max allowed by RBI. And then on top of that, they could again borrow from the banks. This was about a year back scenario. About a year back, RBI came with a guideline, fresh set of guidelines where the entire exposure of an MFI borrower is capped, irrespective of whether it is from an NBFC MFI or from the universal or the small finance banks. So that has given us also some little bit of a comfort that the overheating or the over leveraging by the borrowers is not going to be as much. And so that is why we kind of allowed microfinance to grow a little stronger than in the past. Today, microfinance is about 19% of the book. And by and large, we expect that to remain at that 18% level by the end of the year, which means that microfinance should grow at the overall level at which the bank should grow and retain its contribution from maybe 19, it might come down to 18 by the end of the year.
Okay, got that, Mr. Vasudevan. Just a quick final word. How is cost of funds moving? Because margins have come down. I mean, even if I look at it quarter on quarter, from 9.1%, you're down to 8.76%. So there seems to be some amount of pressure there. What's the outlook for the rest of the year on cost of funds and NIMs?
Yeah, so our portfolio, almost 83 or 84% of our portfolio is on a fixed rate basis, and so you are going to be seeing this cost of funds and the NIMs moving fairly aligned, I would say. And our cost of funds has gone up to 6.93% in the first quarter. And we believe that, based on our own internal calculations, we believe that our cost of funds might actually move by another 50 basis points for the rest of the year. And when that happens, the NIMs should see a reasonably proportionate decrease also. So last year, our NIM was around the 9% on an average for the full year. This year, we expect the average NIM for the full year to be anywhere in the range of around 8.5%.
Okay, all right. We will let you go on that note. Appreciate your time here. Thanks a lot for joining in. That's Equitas Small Finance Bank.